S&P continues to frustrate put buyers. The Nasdaq has its worst week for 2023. Understanding who's buying and who's selling, the recent dollar move and how that's going to affect equities, how the VIX is simply crushing option players. We will address the current buzzwords that are driving certain sectors. We need to address several key indicators that are being misunderstood, address what's going on in the bond market, particularly high yield. Let's jump right into it. S&P is confusing everybody. And by confusing, meaning they're not understanding why we're not dropping. And we're going to address this, but what we're going to do is just look at some very simple technical indicators that are happening right now. And I think that this is very important for us to understand. We have a trend line here. Now, if we get super technical on that trend line and we draw it to that point and we draw it to this point, you can see that you're sitting on there perfectly. So we are still holding this trend line on the S&P, and we have been unable to get back down to any level such as 3,800 that people are expecting us to get to. We have yet to make a lower low, and we keep hearing that it's coming. While no one knows what's coming, it's best to analyze and not predict. So if we just kind of take a look here, you have a left shoulder, you have a head, you have a right shoulder. You should be able to see the neckline, but let's put that neckline right in. So we can see the neckline going straight across, right around that 4160 level, let's call it. And we can see the attempt here, and we can see the failure, just abject failure that happened back here in August. But you can see this pattern, and it's there. Whether we want to see it or not see it, it's glaring. So it's something that we do need to pay attention to. That does not mean that that pattern is going to stick. It also does not mean that we cannot come back down to 3,800. You can absolutely maintain this pattern and still see a retracement. And that's a very important distinction because I see a lot of people really worried about whether or not we're going to come down 3 or 4%. No one really knows if we're going to break or not, but there's a lot of indicators out there that are saying that we have some support. Now, I approach things a little bit differently than most traders, and it's based upon how I learned to trade. And essentially what I look at is what institutions and insiders are doing. It's just from my experience and where my mind goes, and I find it extremely useful. So in front of us, I just have corporate insider buys and sells from XLK. XLK is technology. And there's a very simple acronym I want everybody to remember called IIR. Insiders, institutions, retail. And that's the way that the market goes. It's been that way since the beginning of the time. Insiders know what's going on. Then institutions follow by learning more as more information disseminates. And then retail is finally last. Now, if you take a look at what is happening up here, you can see these extreme readings on the insiders' buys and sells at these levels. And this is over a 10-year period. And you start seeing, what are we doing? We're coming back under this level again. And what that's doing is that's telling us that we're getting in a much better position. Very simply, the way that this reads is this level right here is pessimism. This level is optimism. So right now you can see that for a very long period of time, that insiders were very pessimistic on their companies. This is specifically for corporate insider buys and sells on the XLK. And I want to focus on technology because that's obviously the most volatile sector. But you could look at all the sectors that are out there and you'll see something very similar, but it's way more accentuated here, which is what we're looking for. You can see how we're coming down right here, and now we're in that spot. So what that means is that insiders in technology companies are becoming more optimistic. Now, if we just look at the XLK, and we know that a very large percentage of this, over 40%, is Apple and Microsoft. But just put this line in, just take a look and see where that would take us to. And we're just going to use these exact points. We're just going to use the low points. And you would see that even down here, you'd still be in that channel. So what you want to do with these lines is you want to clone them and then just see if they fit anywhere else and see if that works. And it kind of fits right in here, doesn't it? Now, the issue with that channel is it's a rising channel, and we're not crazy about rising channels because usually they end in tiers. But we are seeing that same exact pattern that we just talked about in the S&P, where you have a left shoulder, you have a head, and you have a right shoulder. Bear with me as I get used to this tool and my childlike handwriting. So you can see that right here, right? And you can see our neckline, but let's just pop that neckline in so that we can go over it, because that's going to be important later when we go over some of the stocks that we're going to cover. So we can see our neckline here, and we can see that rejection and how that rejection sits perfectly with the rejection on the S&P weekly. Now, as we dive into this, I think it's important for us to remember one thing. We analyze, we don't predict. We don't want to predict. We don't want to say what is going to happen. We simply want to trade what's in front of us. But at the same time, analyzing what's going on in the past and seeing how that may affect the future is one of the best tools that we have. Now, in front of us is the smart money, dumb money confidence. And you can just see the color of the lines right here where it says dumb money is in red and smart money is in blue. Now, for our purposes up here, we're going to say smart money is institutional money and dumb money is retail money. The calculations of both of these is extremely important. It's really important you understand how these are calculated. They are done through inflows, put call ratios, and looking at what retail is doing versus what smart money is doing, right? So what we're going to do is we're just going to understand that they are just referring to dumb money as retail and they are referring to smart money as institutions. And just to accentuate that, what we're going to do is we're just going to go here and we're not going to call that dumb money. We're going to call it retail. We're not going to call this smart money. We're just going to call it institutions. Just to make it simple for those that don't understand institutions, think funds. Think your mutual fund, think your pension fund, things along those lines. When we say the word institution, it's a very fancy way of saying that. So if we take a look at what's going on right down here between retail in red and funds that are in blue, we just take a look at the past 2 years, we're going to see something pretty glaring. We're going to see that retail in and of itself usually will peak, and then we will see the institutions get washed out and then come up a little bit, right? Now, there's a couple of really important distinctions that are going on here. To start with, if we just take a look at this particular period in time. So now we've zoomed in and we're really looking at the past 12 months. If we look at when smart money has peaked on the market, you can see later down the line that you have a peak and then we pull back. And you can see it here as well, peak. It'll peak in here, but not as bad. Peak right here where they caught the dollar move. We're going to go over that in a little bit. And then what did they do the entire time the market's been going up? They've been selling. So when we start saying smart money, dumb money, the reason that we're changing that is who's really made money here? So in other words, from this particular point on in October, funds were selling to retail. Retail was buying. Retail bought this move and retail made money. Institutions or slash funds sold during this period in time. If you think about it from that perspective, that means that they're getting out while retail's getting in. That means retail is outperforming funds right now, which is a fair statement if you go and take a look at that data. Why is this important? They can't have that after 2022. Can't stand. So what we're starting to see is we're starting to see retail panic now and get out, and because they realize that we got a little too overexcited in here. And then what's happening is institutions are saying we're taking advantage of that. And we're going to explain why we're not dropping the way that we're dropping in a little bit here. But it's really important to understand that when you look at these graphs and you understand what they really are, you can look at this and have a little stronger of an opinion, right? A little stronger analyzation of what's going on here, because what you're doing is saying, well, institutions are underinvested and it looks to me like they're buying, and it looks like it's retail that is selling. And it is retail that is selling, and it is institutions that are stepping in and buying that stock. For our purpose, what's in front of us right now is the NDX 100. Here's where we opened on Friday. We can see the test, we can see the rejection. The NDX 100 is the top 100 names. You can see the open clearly rejected over and over again. For those that don't know, the people that buy off the open is usually retail. Towards the 230 mark on, and there's actually even an index that tracks this. And we're going to address that in a moment because it's a really critical index. Take a look from that 230 on. That's when institutions step in. One of the reasons why institutions wait is because they don't want you to see the average daily volume of what they're doing. Again, this is how I learned to trade, and I found it extremely helpful over time because it's not mom and pop that moves the market. It is insiders and institutions. Now, if we take a look at this from that 230 level on, we had buying. We came back and retested where those institutions came in, and we had buying again. Here is last Friday, the 17th. And if we drill into this, we'll notice a very similar pattern where the open becomes resistance. And you can see right in here. So essentially what we do once again is we have retail that is stepping in, buying, getting hammered, breaking even. And then what are they doing? Getting out and going, I'm glad I got out of that. Meanwhile, you start going back and taking a look at the 230 level right in here again, and you can start seeing from that level on what's happening. We're actually having buyers step in. Now, whether or not that works for them or not on Monday, institutions are not buying to day trade. Now, for our purposes, we're going to look at the opening price again on February 10th on Friday. And I'm taking Friday because that is option expiration weekly. So you can see what they're actually doing and how they're actually moving in here. Once again, we have the open, who buys off the open, but retail, and then what happens? They get flushed out, trades up, you have a little bit of a gap fill, and then we come back down. What happens at that last hour? How do we do in here? Well, let's just take that 230 level, 240 level again. Look right in here and what happened into the end of the day. The easiest trade has been buying the 230, 3 o'clock level on the index and then just selling it if you want at 4 o'clock or getting out of the way. You can just repeat this over and over again. And frankly, you do it until it just doesn't work anymore. But with institutions this underinvested, I don't see it happening anytime soon. What you have in front of you is a chart that tracks the last hour of trading. And essentially the way that it works is based upon an advanced decline line. And it wants to look at the breadth of the last hour of trading and seeing if it's getting stronger or weaker. Now, the purpose of this is because they know that that is really when institutions put money to work. And if we just take a look here, you can see in that last hour back in November that institutions were still selling. So if we look at that, we'll note that that correlates perfectly with something else. And before we dive into that, what we'll notice here is that I'm going back to when the pandemic happened, and you can see the curve and you can see the inversion of this curve versus the inversion up here. Bear with me as I get used to this drawing tool, but you can see exactly what I'm talking about. Now, if we zoom out on the last hour of trading, or rather zoom in, and we just go to the peak of the S&P, we're going to notice something pretty definitive here, that we're starting to break out on the last hour. So what does that mean? That means institutions are putting money to work in the last hour at a rate that we have not seen in over 2 years as the market comes down. Now, if you look at our retail versus funds lines, and you see what's going on here, and you go all the way back to, let's just take January, we can see that retail interest has peaked, and we can see that we have a trough on institutions coming in. Now, again, if we focus on this last hour, the simplest way to do this is, the way to trade it is you're supposed to throw in a 20-day, some people will use a 50, and then you'll just look for points of inversion. So what do I mean by that? You just want to see where it breaks, right? It's a fancy way of saying where it breaks. So you could see right in here in October 2022, we broke to the downside, and you could see why people would be concerned about this. And see how that fits perfectly with what we were just looking at, where institutions were selling. So they're getting out at the end of the day. And for anyone that was trading in here, you'll remember every Friday there was just outright dumping. Well, since November, what are we seeing? We're seeing that reversion, right? And we're starting to see this push. And now we're actually breaking out of a multi-year high on the last hour. Now, if you take a look at from where that last hour turned and you look at the NDX 100, you will realize that you have never seen it get lower. Why is that? Because institutions are buying. That's what's happening. They got troughed out and now they're stepping in. These are facts. What the market does remains to be seen, but these are facts and we need to be aware of what the facts are. Doesn't mean that institutions are right. They've gotten burnt in the past before, and retail has been right more recently. So we have to put all this together and look at it in the context, but there's a lot of signs here that we have to pay attention to. Any kind of market rally, you want the NASDAQ to outperform the S&P. If you're in a bear market, the easiest trade in the world is the pair trade of going along the S&P, and then you just short the NASDAQ. The exact inversion trade is true. And there are literally institutions that's all they do is this trade. They just put the pair trade on. So if they think that we're in a economic downturn, they will short the NASDAQ and long the SPY. And if you go back historically over time, that's exactly what you're looking at here when you look at these booms and busts, right? And you can see that pretty clearly here. We can see how the NASDAQ underperformed and how it outperformed here, right? Then you have that period of stagnation where nothing really changed, right? We had a pretty good market for a couple of years, and now we have that, huge rally, huge opportunity, and now we have this. Now, I'm not suggesting that this is over, but what I am suggesting is that we have a downward trend line and we need to break. But for that to break and for this to be technically clear, you have to get over 79. And then that's going to put us right at the neckline, right? So we have a ways to go for that to happen. Well, these percentages are huge moves in the market, and we need to be cognizant of that. Now, if you just take a look at that neckline, it is saying that we might be a little tired. So what does that mean? Well, that just might mean that we hit somewhat of a kangaroo market. And a lot of people are not familiar with what a kangaroo market is. And really all it means is that you're going to put yourself in a position where we're going to trade sideways, or what we're going to do is to base. And I think that that's a really important distinction, right? There's nothing wrong with us basing. There's absolutely nothing wrong with it and us doing this. But what will happen is people are going to start getting tore up. In other words, they're going to be buying puts, they're going to be buying calls, and we don't know how long this lasts, and we don't know if we're going to do this, or we don't know if we're going to do that. We just very simply do not know. And that's what we have to pay attention to. A great example of a kangaroo market is the high yield market. If we go back to June and we look at how we're moving right through this level, let's just put that little resistance point up there, right at that 77 level. And let's go here and just take a look at support. This is how I view support and where support is to me. And let's just put that trend line in and let's just see what's going on here. So we've broken that trend line, and what that would mean is that we should just be free falling. And we all know that if high yield comes in, that the S&P should come in. But we've cracked, but we're not doing what we're supposed to do. And this is exactly what is frustrating so many traders. They're not understanding where we most likely are in the economic cycle, which is just that we're going to do something very similar to this over and over again and just frustrate people. Why everyone says we're in a bear market, we're in a bull market, and not understanding that you just might be in a situation where we're going to consolidate for a period in time, and we're going to have to figure out what's going on. Now, this is great for traders and really maddening for investors, because investors are going to be buying breakouts. And what's been working well, if you go and take a look at your trading, and what's been working well this year for us in the Alpha Chasers community is just buying support levels and selling resistance levels. It's worked exceptionally well, and it's something that I would strongly recommend that you take a look at. Understanding what's happening allows us to go out there and make more informed decisions. This is a great example of a trade that we did, and something that we should still be watching as it keeps saying the right words AI over and over again. But on Friday the 10th, we noticed that we started to see this doji here. Now, at the same time, we saw buying on a smaller time frame. Now, by using the last hour theory, you can drill into something like NVIDIA, which was something that we wanted to purchase in the community. And we can see our level right here. We can see inside bar, and then we can see a bar inside that one. And we can see another bar inside that one. And I just look at the bodies. And then you can start seeing what happens in that last hour. Well, we finally get a bar that is above there, and that's really all I needed as a signal. We broke a little DTL right here as well, but understanding where we're at and watching the last hour and understanding that it's institutions buy in the last hour, well, we can keep replicating that over and over again and keep doing it until it no longer works. Eventually, like everything else, it will stop working. But when we can find patterns and replicate them, we can create edge. As far as NVIDIA, now that you're through, you had two wicks here, and we know wicks are price rejection. Well, this had a decision to make, and it made it. Now, whether or not we have follow through or don't have follow through, again, nobody really knows. But I would just point out this huge long green bar in here and this long red bar here. And this was obviously a battle area that was even taking place back here, right, in November. So it is possible to not only gap fill, but to climb this bar and start getting a little higher up here. When you start having this kind of frenzy in a market, it doesn't really matter what we think, right? It really doesn't matter If we think that, oh, it shouldn't have this frenzy, it should have this frenzy. If everyone thinks AI is the next big thing, and the video is going to say AI 180 times on its conference call, that's all that really matters. And then if you start drilling into this on a weekly, you can start seeing these setups even clearer. You could see your left shoulder, and then your head, right shoulder, and then you can kind of see the neckline right there. So that's really what we're looking for. Replicatable patterns. As far as some of the other leading names, all we've really seen here is Tesla just chew people up. Now, look at our little weekly level right there. Roughly, to me, it's down just a little bit to here. And what I'm looking for is as many data points as I can possibly get in one area, right? So you can see that 220 seems to be somewhat of a sticking point in there, but you are staying up here. Now, this was the first red bar that we've had on a weekly all year long. And that just means that maybe we're going to slow down, maybe we're going to respect this, but we really don't know. What it does do is it makes it very clear that anyone that's playing options on Tesla right now is really just kind of playing around because they're just getting chewed up. And they've been getting chewed up despite what they're telling people. They are getting chewed up. And you have to be very nimble because, in other words, what you're seeing is you're just seeing this range between 216 to 188, and then you're seeing it down here, 191 to 209. You're just not going anywhere. So what we want to see is we want to see this bar make a decision on a weekly and then go from there. Drilling into a 2-hour chart, you can see that these levels are setting up and right in here, even though the weekly we're starting the turn, this 2-hour, you could actually say you have a left shoulder, a head, and a right shoulder right here, with a neckline down around 187 3/4, let's call it. So we do need to be aware of this. But for now, we're not really breaking down. Now, you could look at this trend line and look at these points of interest and then say this is something that we need to pay attention to. And I could see that, and that is a valid argument. So we're going to watch that trend line and see what happens. But that does not mean that we're going to fall out of bed. It could just mean that we're going to go sideways. If we zoom in on a 15-minute chart and just take a look at that last hour, it's pretty clear that you had buying stepping in. It's pretty clear that you closed near the highs of the day. So something for us to think about. One of the key things we always want to watch is XLY versus XLP. Now that is consumer discretionary or retail, and that is versus staples. And why this is important is because funds always have to be invested. If you're an institution based upon your mutual fund, based upon what your charter is, you always have to have some level of investment. Now, they'll just rotate into healthcare, but the primary rotation is always into something that is a staple, hence XLP. And seeing if you're holding one particular level and is that level a substantive level. And it sure seems like it, where if we've broken down over the past couple of years, it's only been for a couple spots, but we can really very clearly just see the support line. This is the pandemic when everything sold off, and you can see what happened back here in July and how we held that area, broke again, right? And then you can see how that is in December and then the rally of XLY. And now you're trying to hold in there again. So what we want to see is we want to see this at a minimum hold. We don't want to see XLY consistently underperform XLP. That is not what we want to see, because that just means that people that have to put money in the stock market are being defensive. And they've been defensive since November 2021 when this peaked, which of course was the peak in the market. This correlation is extremely helpful in determining how hedge funds or institutions, pension funds are positioning themselves. Basically, we take consumer staples and compare it to technology. And if we just go back here from 2000, we can see the great underperformance and peak of the market. We sold all the way off on tech, and people were just buying the Procter & Gamble's, Colgate's of the world, until we bottomed right around the bottom of that market after that huge 2-year drop. You can see the great financial crisis right here and how that's delineated by what happened. It's very obvious, these peaks. And you just kind of go through and see very particular periods of time. The majority should always be trending down versus tech, right? That's the way that we normally go. And we can see that from 2017 on. But you are going to get these periods of outperformance. The important thing is to drill into those areas of outperformance. Not just focus on the macro, but just look for where you're getting those. So in other words, we had it right here during the pandemic, and that makes sense. Everybody's selling tech, and if they have to have money in the market, they're buying staples. Now, if you drill into what has transpired over the course from November 2021 to now, we have had significant outperformance of XLP versus XLK, meaning if you bought Staples versus buying Apple and Microsoft, you did better. And with this neckline breaking, it looks like that may be coming to an end. You can see UNG here on the weekly. I do like this particular pattern on the weekly. So I have a bullish engulfing. In other words, I have undercut right here and I've closed over it. So this body is encompassing this body. That's a bullish engulfing pattern. Now, you would have to basically use the low of that bar as your stop. And if you're not a big bottom fisherman and you're not willing to take that risk, don't do it. But I'm just going to suggest that you consider it, considering the upside that you could have here. You can see your neckline very clear right up here, up to that 18, and a retest or a gap fill over the next couple months. I don't think that's unrealistic to see that you could get up to that 14 or 18 level over time. ZIM is on my radar this week. I think this is very significant. We can see the way that we're just trading sideways down here, and then we flip, push, retest, comes back down and pushes again. This is fairly significant to me. Now you have earnings that are coming out in the next couple of weeks. If you're familiar with the story, their earnings are pretty substantial, but the dividends are usually pretty substantive. And if we have a decent dividend here, you're going to see that push into it as we get closer and closer to the day. Earnings are the 13th, and we'll see how we act going into there. If you like today's video, please comment on the format. This is much longer form, much more general about what I see going in the market. I think that this is more helpful than just the individual names, although I would keep throwing in individual names. I just am interested in your comments on that. To get the free newsletter, there is a link in description. Simply click on the link and you will be able to get it and follow along daily as to what we're doing and what my thoughts are on the market. And if you like everything, do me a favor and please like this video. It helps me greatly with the algorithm, and subscribe to the channel if you want updates, because the notifications that we put out there are not only in the videos, but also in the community tab, and you will not see those unless you are subscribed to the channel and click all notifications. Have a great trading week.